Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, April 23rd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are why gold's correction may deepen, plus fresh evidence of our green shoots globally theme. So the nuance there is that the correction in gold deepens down nearly 1% today, which takes its week to date pullback to minus 3%. Elsewhere, our conviction in our green shoots globally theme rises after the preliminary April PMI data from around the world confirmed the pre existing condition of every major economy in the world having a composite PMI that is trending higher. In fact, every economy that reported April data thus far saw its composite PMI accelerate sequentially. In terms of market implications, if quote unquote safe haven demand from the East is truly what has driven gold higher in recent months, gold bulls must be aware of a potential downside surprise in U.S. Treasury net financing estimates via the Q2 quarterly refunding announcement next week. Our Green Shoots Globally theme is contributing to the sustainability of the current risk on reflation market regime, and alongside our resilient U.S. economy and Jay and Janet want a soft landing themes suggest the current corrections in stocks and other risk assets are unlikely to deteriorate into crashes. As always, we'll wrap up with a question from our community here on our 42 macro dashboard. So this is an interesting question here titled Proactively Preparing for RORO. And for those who are not familiar, RORO is our nomenclature for a risk on our market regime phase transition from a risk on regime, which is Goldilocks or reflation, to a risk off regime, which are inflation or deflation, and vice versa. Thanks for putting slide 13 into the deck in last week's ATH. I'm an RA in Australia and have started the process of looking at portfolio tilts for different clients. I have a question about the utilities factor. Utilities can easily be placed in the same bucket as interest rate sensitive assets, such as REITs, which in a high inflation, high interest rate environment is unlikely to work well. After looking at the ETF XOU, it seems that the ETF is focused on essential infrastructure. Is that correct? So yes, just a couple things to hit on there. Yes, ETFs or the XOU is generally focused on essential infrastructure, things like power, electricity, all that kind of stuff. And then with respect to the utilities factor, it's very much an interest rate sensitive asset, similar to REITs. You know, REITs and utilities tend to have a very similar performance characteristics across the four grid regimes. When you think about it from a expected return, percent positive ratio, volatility and covariance perspective. So getting back to the question, would it be right to assume that this category has been included in the risk off list of factors because utilities are likely to have regulated or contractual income linked to inflation? The reason utilities and REITs and things like healthcare and consumer staples tend to outperform in a risk-off market regime, tend to outperform other sectors in a risk-off market regime is because they are low beta. Low beta is one of the more dominant forces in asset markets from a factor dispersion perspective whenever you transition from a risk-on market regime that favors high beta risk assets into a risk-off market regime, which typically favors low beta assets. Obviously, when you make a regime rural phase transition from a risk-on regime, diversifying out of cyclicals and into defensives is another pivot you're likely to make there. So so I think when you think about this from a back testing standpoint, okay, why are utilities one of those defensive low beta factors that tend to outperform when you're in a risk off market regime? And the likelihood is probably because they have regulated contractual income and their operating metrics are a lot less cyclical than other elements of the market. Think about consumer discretionary tech, it's comm services, et cetera. So so just be aware of that. That's not what's driving it, in our opinion. We think what's driving it is just there's so many investors who are a lot of the asset allocation decisions and capital allocation decisions across the global buy side now are very factor driven. We have a process for trying to identify inflections, critical inflections in the market from a factor leadership perspective. And so does every major hedge fund and major asset manager on the planet. So a lot of what you see at 42 Macro here is just my learning from all those major hedge funds and major asset markets and asset managers over the course of my 15-year career on Wall Street, and trying to piece together what I thought were the best practices from those various funds. And that's what you see here at 42 Macro Research. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Tuesday, April 23rd, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.